The wheel strategy is one of my most favorite trading strategies, and it is actually very profitable. In order to understand the wheel strategy, you need to understand perfectly how selling options work, both selling a put and selling a call option. If you don't know how selling options works, you first need to understand them. You can either watch my YouTube video or within my free course in the option part, there is this video. I found this picture online from investgrade.com which will explain perfectly the wheel strategy. So in the wheel strategy we need to choose a stock and we're going to start selling puts. We know that when we sell a put, if the stock expires in the money, we're going to buy 100 shares plus we're going to collect premium. However, if the stock does not expire in the money, we're just going to collect premium. So in this case, we're just going to sell puts until the stock expires in the money and we buy 100 shares. If the stock does not drop below the strike price, we're just going to collect premiums. So it says, if assigned, we're going to buy 100 shares. So now we hold 100 shares of the underlying asset. So at this current stage, we have 100 shares of the underlying asset. On this point, we can start selling covered calls. We know that on the covered call, when we sell naked call option, we have no risk of assignment because we already have 100 shares. So the worst case scenario will be we're going to collect the premium plus we're going to take profit on the stock. So in this case, we're going to sell calls and collect premiums until the stock expires above our call strike and we close our 100 shares position. So it says if assigned, the stock will get closed because we already have 100 shares, and the call contract, if it expires above the strike price, it will sell 100 shares, so it will close itself. And we always continue this whole wheel. We just continue doing selling puts, selling calls, selling puts, selling calls, which will always collect tetas. I'm going to explain you the strategy on Apple so you'll understand perfectly. Maybe the idea is not very clear now, but now you're going to understand much better. This is the chart on Apple and we currently want to buy at 165. So this is where we want to buy Apple. The current price is 171. We know that if we want to buy at 165, instead of just waiting, we can sell puts at 165. So now instead of just waiting, we're going to collect an income while waiting. You can see on this option chain, the 165 strike put contract is $230. So the first thing we're going to do is to sell this contract. There's two scenarios that can happen right now. Apple in the next 12 days can stay above 165 and we're going to collect the $230 premium. The second scenario is that Apple will drop below 165. We're going to collect the $230. Plus, we're going to buy 100 shares at 165. So at this current stage, we have 100 shares at 165 and we got paid $230 in premium. So after we got assigned 100 shares of Apple at 165, we have a target to sell. We have a target on Apple to sell at 175. So we bought 100 shares at 165 and we want to sell at 175. Again, instead of just waiting to sell at 165, we're going to sell calls at 175. We go on the option chain and we check the 175 call contract. The premium is $300. In the next 12 days, if Apple stayed below 175, we're going to collect the $300 premium. What we can do now, instead of just waiting again to reach 175, we can sell again another contract at 175. So we're just going to keep selling those contracts until it reaches 175. So the second time we're going to sell again this contract and we're going to collect tetas. But on the next time Apple did reach above 175 and it expired at 182. So in this case, since we have a covered call at 175, we are forced to sell our shares at 175. So in this case, we bought at 165, we sold at 175, and we made $1,000 from the shares. But since we sold those contracts, the put contract and the call contract, we collected another $800 just from premiums. So instead of waiting, we collected an extra $800 of premium. So our average, instead of being 165, it dropped $8 more. So our average, instead of being at 165, it will be 157, which is 165 minus $8 because we collected $800 worth of premium. And after that we closed our position, we can do the same thing again. We can sell puts again at 165. After getting assigned, we sell covered calls. So this is the wheel strategy. So now you kind of understand why this is my favorite strategy. Instead of waiting, we're going to collect premiums and we're actually going to buy a lower price than the current market value because we're selling out of the money puts. So a small recap, we're going to sell out of the money puts until the stock gets assigned and we buy 100 shares. After we bought 100 shares, we're going to start selling covered calls and we keep doing it until the stock reaches our target and we get signed and we close our 100 shares for a profit. And I'm a big fan of selling puts because we're actually getting paid to buy at a lower price. And the same thing is happening with the covered call. We're getting paid to sell at a higher price. That's why the wheel strategy, it's a great strategy. The only problem with the wheel strategy, you need to have the amount of 100 shares of the underlying asset. 100 shares of Apple at 170, that's $17,000. 100 shares of Tesla, that's $100,000. But the premiums are relative. Each time you're selling those weekly contracts, you're making 1 to 3% return per contract. So that's a great return per week. Every single time you're selling those weekly contracts, you're making around 1% per week. Just because you're waiting to reach your target. And every single time you're selling those contracts, you're almost making 1% on the 100 shares. So if you sold 4 weekly contracts, you're getting paid weekly more than any dividend stock. So that's why I like to sell puts and covered calls. And if you combine together, that's the wheel strategy. So thanks for watching and see you in the next video.